Hi there, Paul Carson here with Philadelphia Mortgage Brokers, and I just want to take a minute or two to chat about getting a second mortgage in today's lending environment. So there are a lot of folks who are fortunate enough to have very low interest rates on their first mortgage, but they're still in a position where they need to set up availability to have access to funds or get those funds for any number of reasons, whether it's home improvements, debt consolidation, anywhere kind of in between. So there's two main options when considering getting a second mortgage. The first is a HELOC, a home equity line of credit. Think of that like a credit card tied to the equity in your home that you don't have to use. So for example, if you got a HELOC for $50,000, that limit is available for you to draw on for any number of years. It could be 5 years, 10 years, as many as 15 years draw period on that credit line. So if you don't use it over that term, you're not going to incur any interest because you haven't used the card at all. Alternatively, if you got that $50,000 credit line, you took the $50K out on it, you'd begin to make payments on that balance within a month or so after you use the funds. Now there's options to how you can pay this back. Some banks and credit unions offer interest only, meaning only the interest is due on a monthly payment. Principal and paying down that balance is optional and at your discretion. So you can pay principal every month, you can pay it once a year, you can not pay it at all during the interest only period. It leaves you with the flexibility to pay it down as you see fit based on your budget and what you want to do. So there's a lot of flexibility with the home equity line of credit. The less flexible option is the home equity loan. So that is a set rate and a set term. For example, let's say there's a 10 or a 15-year fixed second mortgage. When you look at a home equity line of credit and a home equity loan side by side, the variable rate home equity, the HELOC, is usually going to be a lower interest rate than the fixed rate home equity loan. So you get generally a slightly better rate on the credit line versus the fixed home equity line. The reason I mention that is it is variable. So home equity lines are tied to prime rate. And as we've all been watching the news recently, prime has been steadily increasing over the past year and a half as the Fed has raised Fed funds rates. So prime follows in lockstep with the Fed funds rate. And if you want to avoid any future interest rate increases on a credit line, the home equity loan is going to be a better fit for you if that is your priority. But if you wanted the flexibility to pay down the balance as aggressively as you want and have that payment continue to go down as you pay down that balance, the home equity line of credit is a good option to consider. So if you have questions about how second mortgages work, is a HELOC right for you? Is a home equity loan right for you? What do the terms look like? What do the payments look like? What do you need to do to get one? Let us know. We can happy to explore your options with you, show you how these products work, and see if they're a good fit for you. Any questions, reach out to us on our team at Philadelphia Mortgage Brokers. You can find us at phillymb.com.